different types of accounting for them. And the accounting is different because of, for what we're doing, the ownership, but also of what kind of item it is. Okay. They've actually kind of cleaned this up a little bit, but the categories, the first categories, the first three we have there are for debt securities. So this is if you buy bonds. Say, let's say the example is be buying IBM bonds. So you're not buying stock, you're buying their bonds. And here's the thing about that is a little different from these other investments, and that is that if you own bonds, you're not actually the owner of the company. You're a creditor. You own the money, so you don't actually have any ownership. You're not going to. You can't vote on the board of directors and all that kind of stuff. Okay, so and the way you make money is through the interest. They'll pay you back the principal, but also a little interest at it. So there are different categories of it, and we'll talk about this. Held to maturity is the first one, and held to maturity is when you hold it for the entire length of it. So it's a 5-year bond, you're going to hold it for 5 years. You plan on holding it for 5 years. I should also mention all of these are based on many of these are based on management's plan for it. So if management says, believes that they are going to hold these for 5 years, and it appears that they can do that, they're financially stable enough to do that, then they use a held to maturity. This is only for oops, I'm in my basement here. I'm sure sometimes you see people walk by with laundry or milk or something.
Oh, no problem.
We actually have an office, but my wife is a therapist, so she uses the office. Yes, has confidentiality.
Absolutely. You don't want people walking by with laundry during therapy.
Right. So if someone eavesdrops on accounting, nobody cares. So all right. So held maturity. Now this is only for bonds and debt securities because stock doesn't have a maturity. You can hold an IBM stock theoretically for ever, even pass it down to your children and all that kind of stuff. So because stock doesn't have maturity, we're only talking about debt securities. So these are things so they can hold until they mature. Trading is when they're available to be sold at any time, and usually this is based on the market. If these bonds go up to this, we're selling. So they can be sold at any time. And I know these are kind of vague terms, but the last one there is debt securities that are going to be held for a longer period of time. Now, this means they're not immediately available for sale. So if they're not immediately available for sale, it could be you're going to sell them in 3 months. So it still maybe be a short period of time, but it's not immediate. It could be you're going to hold on to them for they're 10-year bonds. You're going to hold on for 6 years. Okay, it could still be long term. So available for sale can be either short term or long term, but they're not for sale immediately. These are for sale. The trading securities are for sale immediately. And I know that those terms are not really descriptive, but that's what they use. So, and these are only for debt securities.
Okay.
Now, so going down here, this is what we just talked about. There is a kind of weird thing, and this used to apply to all of them, but they have a thing called unrealized gains and losses. This is when the market value changes So yeah, let's say you have IBM bonds and the market value changes, goes up or down. You could have what they call an unrealized gain or loss.
Mhm.
And the reason for that is that even though there's a loss, it might not be realized. This is kind of especially true for debt securities, bonds, things like that. Because at the end, if you have $10,000 worth of bonds, at the end of its life, they're going to be worth $10,000. So a lot of times these gains and losses, if you're going to hold on to them for a longer period of time, are temporary. Depending on the market, where the interest rates do or whatever. So they can go up and down. But a lot of times they will, especially the longer you hold on to them, that they'll wash out. So they call these unrealized. They go into comprehensive income. We're not going to get into that. It used to be they had equity securities going there too, but now these are the only thing that goes into their debt securities. So unrealized gains and losses are on there, and those actually do not show up on the income statement. I'll put it here just for completeness. They are on the statement of comprehensive. Which is a statement that I always thought was going to go away, but now the international standards have adopted it too. So I guess,
Oh, interesting.
Yeah, I guess it's unlikely that one's going to disappear. It used to be only the United States had this. I was hoping they'd get rid of it, but they didn't. And it's basically those things that are longer term, and like I say, especially for things like the losses, like in this case, that are kind of they're iffy. It isn't that they didn't happen; they did. Price went up or the price went down in the bonds, but that they're less likely to stick. It's less likely that there are going to be losses or gains or losses in the future, or at least a smaller extent. Okay. Now, that was almost something we don't care about for this course. This is the one we actually care about. Equity securities. Well, I shouldn't say we don't care about it. I kind of teach this class a little bit towards the CPA exam. And the CPA exam does a lot of categories. And they'll say what was the income for this investment, and if you don't know which category it goes into, you're going to have a real hard time with the what the income is on. Okay, so these are equity securities, basically stock. And so if you buy IBM stock, that is an equity security. And there's three basically different categories for these. There is the fair value method. And this is kind of like we did for debt securities. But the losses, so for instance, if IBM stock, you have IBM stock, you bought it at 100 and it goes down to 97. Okay, you lost $3. Unlike bonds, there's no guarantee that that's going to come back. It might just keep dropping. And so when it comes to equity investments, we don't use the unrealized. We used to use it, but nowadays we don't use the unrealized gains and losses. They're just losses. So if you have IBM stock and it goes down to 97, that's just going to be a loss. If it goes up to 105, that's just a gain, and it goes right on the income statement. So now notice you didn't sell the stock, but if it goes up in value, so they talk about the fair value, and the fair value for like IBM, it'll just be whatever's in the stock market price. Okay, now that's if it's non-influential. So now,
meaning you own under 20% of that company, right? Of that company's stock.
Well, this is what's kind of strange though. when they put these methods out, one of the examples they gave was 20%. That stuck for some reason. So the real credential is that it's non-influential, so that they can't influence the decisions of the company.
Mhm.
Now, if you owned 10% of IBM, you would definitely be influential. You probably have a couple people on the board of directors at least. So this really depends on what the company is. If you own 10% of a small company and somebody else owns 90%, well, they're probably not influential.
Mhm.
You voted 90 to 10 every time. So the influential, this is really the criteria. Again, this was just put in there as an example, and for whatever reason, it's now, it's the standard that some people use. And so basically, you look for an influential. If they don't tell you whether it's influential or not, then you go to these percentages. Now, tell you something. So it could be non-influential or it could be influential, based on it even if it's under 20%. Now, influential, they said, is 20 to 50%. That's kind of one of the examples that they gave was, I think it was about 20% that it was influential. Again, that's not always the case. Publicly traded, absolutely. If it's a small company and you own 40% of the stock and someone else owns the other 60%, probably not influential. Now, if you own 40% of the stock and there's 5 other people that own the rest of it, then you might be. So it really depends on the size of the company, more specifics. But if they don't give you this, they don't say whether it's influential or not, then you go to these standards. Controlling over 50%. So if you control over 50% of another company, that is considered, it's considered that you kind of own it. And the financial statements are consolidated. So they will have consolidated financial statements. If you look at many large companies, they'll show you their income statement, and then they'll show you a consolidated income statement. So for instance, if you look at Ford, they have a Ford income statement, and then they'll have a Ford consolidated income statement that'll have all the other companies that they own, or that they have at least 50% ownership of. Actually, over 50% ownership of will be in that consolidated. Mm-hmm. So it's and by the way, they take the entire company, even if they'll say they own 51%, they're going to take 100% of the company and put it on their books. They're going to back out some of it later, but they basically take 100%. And the reason being is that they control 100%. Even if they have 51%, they control 100% of the company. Okay. So it's based on the control. And so if they control the whole company, even if they don't have 100% of the stock, the entire company is put on the books for the consolidated financial statement. Now, not for their regular financial statements, for their, like Ford when they do their company, it's just Ford. But any company that they control, they will put on the books. Okay. All right. Ooh. We could do a poll. Yeah, I guess we don't have to. We just do this by ourselves. Okay, so one of the things that we kind of look at is, and one of the big things that they do in the CPA exam is classifying. So classifying what the security is. Okay, so I'm going to start with the debt securities, and remember the debt securities. Actually, we can copy this stuff. I'm going to copy this stuff. Okay, so the question is where, these are the choices we have for debt security. So given this information, where do we, what kind of accounting method do we use? Okay, first one, 5-year treasury bonds, and they intend to hold them for 5 years.
So that'd be held to maturity?
Yep. Here. Purchase 5-year treasury bonds. Management intends to hold the investment for 2 years.
So available for sale?
Yep. Yeah, they're not going to sell it immediately, so it's not going to be a trading. It's not going to be held to maturity. And the equity method, I don't know why I put that in. It never applies to that. Purchase 5-year treasury bonds as an investment. Management intends to sell this investment within the next month.
So that's trading.
Yep. And so trading, by the way, just so you know, trading is the only one that is definitely a current. Trading securities are always current assets.
Okay.
The available for sale may or may not be.
Mhm.
You know, for instance, this one's 2 years. This would be long term, but it could be 2 months. It would be short term. You know, if they don't plan on selling it immediately. Okay. Equity securities, and this is the one that we're kind of more related to what we're doing. So equity securities, maybe I should. Why is that confusing? Those 3, 4, 5, 6, 4. Okay. Well, we'll get that a different page. All right. So purchase 100 shares of General Motors stock as an investment. Management until it tends to hold this investment forever.
So I thought this was about what percentage of the company they have. Is it about whether it's influential or non-influential or controlling? But how would you know? Because you don't know how many stock shares there are for General Motors.
Yeah, for the most, yeah, you're absolutely right for the most part. Now, as far as General Motors are concerned, they probably have millions of shares.
Right.
So if they purchased 1,000 shares of General Motors stock, most likely where they're going to fall.
So non-influential.
Yeah, probably fair value.
Mm-hmm. Fair value, right.
Purchased 1,000 shares of General Motors stock as an investment. You're gonna hold this for 3 years.
So would that be then influence or equity method?
Nope.
No, it would still be fair value.
Exactly. You look
Okay, because it doesn't matter, right?
Yeah, most of these are not. The length of time doesn't matter for these, generally speaking. So it's still be a fair value. Versus 1,000 shares of IBM stock or investment sells an investment fund to fund next month's payroll.
So that would still be fair value then, right? Yeah.
And again, that's new. That they used to transfer them to the trading securities, but that's no longer an option. Well, it's basically the same thing. You know, that you're going to. There is no distinction between trading and available for sale.
Right.
Okay. Equity securities. Oh, we're on it. Purchase 25% of LICO stock as an investment. Management intends to hold this investment for at least 3 years. Okay, now they didn't tell you whether it's influential.
Right. So, I mean, but that probably would be influential because it's still in the 20 to 50%.
Exactly. If they don't
So
give
it'd be equity.
If they don't give you the what you're looking for, basically, is influential or not, then you go to this general rule.
Right.
The equity method. And that's one of the things they test on CPAs, because they'll say, you know, they won't give you. And actually what they'll tell you is if you don't know whether they're influential or not, then you basically use the equity method. It's between 20 and 50%. Okay. Purchase 300% of live co-stock investment. Management tends to hold this investment for at least 3 years. The other 75% of the stock is held by the founder of live co.
So it'd be fair value.
Yeah. Yeah, because they're probably not influential. You know, they'll be outvoted 75 to 25. Purchase 60% of the outstanding shares of General Industrial common stock as an investment. Management tends to hold this investment for 2 years.
So that would be consolidation.
Yeah.
Consolidation.
Yeah, and notice that it doesn't mean they have to hold it for really, you know, it isn't like 10 years or whatever. It's how much stock they own, how if they're influential or controlled. Okay, purchase 10% of the outstanding shares of stock as investment. Management tends to hold this investment for 2 years. Management has 2 officials on the board of directors of General Motors.
So I guess that would be equity because they'd be influential.
Yep. Yeah. If you have anyone on the board of directors, you're definitely influential. You're not controlling, but you're influential. Purchase 3% of the outstanding shares of Ford Motor Company stock as an investment. Only require 4% of the voting rights. Management tends to hold this investment for 7 years.
So fair value?
Yeah.
Because of voting? Yeah.
Because you're probably not influential. And by the way, the Ford Motor Company does have it. The Ford family still owns most of the voting rights. The stock you buy Ford is not doesn't have the voting rights.
Interesting.
Yeah. So purchase 30% of the outstanding shares of Peabody stock as a short-term investment. Management tends to sell this investment when the stock reaches $80 per share.
I guess that would be. I guess it would be equity, right?
Yeah. They didn't tell you whether it was influential or not, but it's in that 20 to 50 range.
Right.
Okay. So this is basically, let me change the page. Is this what you have on page 4?
Yeah.
Okay. Okay, so the equity method. The equity method is what we're going to focus on for this chapter. So the 20 to 50% range. And the reason we're doing this is because the same accounting method is usually used for consolidation that we're going to talk about maybe next week. So that's kind of why we're doing this. Now, here is the kind of strange thing about the equity method. It's sort of like if you own enough of something, when you get paid from it, you're not any better or worse off. So for instance, if I have my wallet, and if I took out $10 out of my wallet, how much wealthier am I?
If you took $10 out of your wallet, you'd be $10 less wealthy.
Well, actually, I'd be the same.
Oh.
I got $10 in my hand in my wallet, now it's $10 less.
Because you haven't spent it yet. Okay.
So here's the thing. Things like dividends don't matter when you own enough of the company. You know, if you have enough of the company, dividends aren't going to matter. Because if they pay you dividends of $10, okay, you got $10 in cash, but now your investment is worth $10 less. And so that's the kind of the whole thinking thing of it is when you own so much of it. Sometimes it's easier to think about if you own 100% of it. You know, if you own 100% of a business and you take $100 out, you're no better or worse off. You got $100 cash, but your business is worth $100 less. whatever it was worth before. So you, things like dividends don't really matter. I mean, we do journal entries from them, obviously, but they don't matter as far as the value of the business.
Mm-hmm.
The only things that matter is how much income you make. How much income does that business make? That's the thing that matters. So the big, the kind of strange thing for this is your investment income is basically if the company makes net income, you make net income. We'll talk about these. We'll talk about this one next, and then comprehensive income. We're not going to get into that, but the amortization of excess. We'll talk about that later. But basically, the idea is, by the way, these two kind of go together. These are kind of, we'll talk about later, but these two are kind of one and the same.
Okay.
But it's basically your net income. You know, if you own 100% of the company, how do you make money? Well, if the company makes net income, then I make money, right?
Mm-hmm.
So that's what it is. It is possible that if you sell the investment, you might have a gain or loss on it, right? I mean, just like anything else, if you sell it for more than you bought it for, you have a gain. If you sell it for less, you have a loss. Okay, the investment account. So this is on the balance sheet. I don't think let me take green. Yellow. Okay. So how does the investment get bigger? Well, it gets bigger if you have income. It's worth more. And going down here, you'll see the dividends. Any dividends that you receive from there will reduce the investment, kind of like taking money out of the wallet.
Mm-hmm.
You own 100% of that company, you take money out, $100, whatever. You have $100 cash, which you put on your books, but that company is now worth $100 less, and so we're going to subtract it out. Let me just cover this. Oh, I know why I put this in here. This is where does it go? Where does the gains and losses and all that kind of stuff go? So this is our income statement, the multi-step income statement that you remember by Scoot.
Okay.
So Scoot, and this is the one that we kind of focus on for this. Other revenues and losses, because this is your investments basically. So
Mm-hmm.
for instance, if you're a Ford Motor Company, you're gonna have your sales, cost of sold, your operating expenses. These will all be based on Ford, but then they'll also have investment income. These are all for making cars, whereas this is on your investments. You may lose money on the cars and make money on the investment, and vice versa, and so on. So other revenues and expenses are where you're going to see the investment income or losses, and if you sell it and you have a gain or loss, it's going to be down here. Ford is not in the business of selling stock; they're selling cars, but it just happens that they could get there. Okay, equity securities. You'll also notice something here on the balance sheet in the investment account. It doesn't matter what the market is. So the market might go up or down or whatever. It doesn't matter as far as the equity method is concerned. Just like in your company, if your company, whatever's on the financial statements and that, it doesn't matter what the stock price is. The stock price doesn't have an impact on the financial statements. Same thing.
Mm-hmm.
It won't have any impact on it. And the idea is that you own so much of it that it doesn't matter what the stock price is. It only matters if you make money. Okay. All right. So number 5. I think this should be on page 5.
Yes.
I got my numbering out of whack here. But so basically, we're going to start talking about some of the equity method and kind of the journal entries. How good are you? How well do you do journal entries? Are you okay with them? Are you comfortable with them or not really?
No, I mean, I'm pretty comfortable with them. Sometimes I mix stuff up, but for the most part, I think.
Okay. By the way, at the end of this thing, so yeah, at the end of this, I kind of have a, I don't want to call it cheat sheet, but whatever it is.
Yeah.
And basically, I'm going to go ahead and tell you because I tell this to my 110 students, and I know they don't. They probably don't care actually, but one of the ways you remember it is that expenses and assets are debits. They go up with debits basically.
Mm-hmm.
If you think about it, that's what you spend money on. Spend money on expenses, phone bill, and all that. Or you buy equipment, buy inventory, whatever. So these are what you pay out. And this other side is money that comes in. And they go up with credits. So money goes out with the debit on this side, expenses and assets. Money comes in on the revenues, liabilities, and equity for with credits. So it's kind of a, I don't know, if you think about it, it kind of like on the balance sheet anyway, it increases on the outsides. The debits are on the outside, they increase, and the credits are on the outside. So yeah, so that's what we're going to do. And for the most part, expenses are virtually always going to be debits, unless there's an error or something. They're debits, and revenues are always going to be credits. And there's a reason for that. The reason is, as time goes on, your expenses are always going up in total. So, for instance, what's more, 1 month's worth of rent or 2 months worth of rent?
Well, 2 months worth of rent.
Right. So expenses just keep going up and up. Again, unless there's an error or something.
Right.
But generally speaking, it always will be debits. Same thing with revenues. 2 months worth of revenues, more than 1 month worth of revenues, they are always going up. So they're virtually always going to be credits. So expenses and revenues are, revenues. Oh, I did something crazy. Okay. Yeah. So, but anyway, yeah, you look at that, and it's all. Ask me. Okay. So January 1st. The corporation was purchased for $35,000. So, well, let's take the easy part. What happened to the cash? Did it go up or down?
Cash went down. Assets went up.
So cash. Yes, you're basically trading one asset for another. So cash would be an asset going. Oops, nice asset. That's not easy. An asset going down for $35,000. And we're going to put this into an investment account. Oops. And we'll probably also put it on there that this is an equity account. And you're absolutely right, this is an asset going up. Oops, put a number in there. Okay, so and basically at this point we're they're no better or worse off. They traded one asset for another.
Right.
Hopefully that changes. But okay, so Franco Corporation paid total dividends of $5,000 to shareholders. Now here's the question: how much of those dividends did we get?
So because we have 30% of Franco, that would be, let me think, of course I didn't bring my calculator. 30 times
Exactly, yeah, I mean,
1,500
Yep.
would go to.
so 5,000. Okay. Oops.
Yeah.
Okay, I got that in the wrong line. I'm gonna need a,
Hmm.
need a count to go there. Okay, so this is on May 23rd. Okay, so the cash will go up. They paid it to us.
Mhm.
Oh, I did. Oh, I didn't. All right, 1,500. Ooh, too many. And now this is where it gets a little strange. So we got $1,500 cash, but we own so much of this company, 30% of it.
Mhm.
And what we're gonna say is, look, this company isn't really worth as much anymore. So
Okay.
we are going to take that $1,500 out of our investment. So our must not have fixed those. Dumb of me. So this will actually decrease the investment account.
Okay.
And we're still no better or worse off than we were before. Right? Because we paid 35,000 for it. They gave us 1,500 in cash. Our investment is now worth $1,500 less. So it's basically trading one asset for another. And now we got the cash, 1,500, but our investment is worth $1,500 less. So at this point, it's a wash. There's no
Right.
loss or anything. But it's kind of a strange way to think about it. You get a $1,500 check and you're no better or worse off. Okay, down here, Franco reported income of 20,000. Okay, so how much of that income do we take? 30%, I think. Yeah, 30%. 6,000.
Right.
All right. Okay, so let's put a date on this. So here's what's going to happen. Now, notice there's no cash coming out of the place. This is just they report their income, they put their financial statements, we get the financial statements. Oh, they made that income for the year of 20,000. So from that, we're going to say, look, our investment now, it made some money. It made 20,000. We get 6,000 of that. So our the value of our investment is going to go up.
Mhm.
Now, our share of it is $6,000. So I think that I think the term is equity. Oops. Let's see here.
Close enough.
Equity in income. If you just put income or else, I would probably put it as a investment, equity investment income or something. I don't know, whatever we put it in. But basically, this is the most important word there. And so that'll be 6,000. I know I don't like this term because it's the equity method,
Oh, yeah.
and you know that. I mean, it also is the description of the account, but they're using it here as not a description of the account. They're using it as, oh, this is how what percentage you get.
Mhm.
It doesn't matter. Okay. I just did this wrong. I apologize. That is not where that goes. That goes as a credit. That's money coming in.
Mm.
My fault. Yeah, that's a credit. I just showed you that and then I put it in the next spot. Okay. So this is sort of like a revenue. It's money coming in here. It's the income.
Right, because equity is always a credit.
Yeah, like 5 years ago, they would call it investment revenue. So income and revenue are interchangeable. Sometimes called profit too. Profit and loss statement is basically revenue and expenses. All right. Oh, so our investment will now increase. Our investment will now go up by 6,000. So it's an asset going up. And so it says, look, our investment, you know, we've made $20,000. Our share of it's 6,000. So our investment went up by 6,000. Okay. One of the common things it's asked on like a CPA exam or whatever is that you know what's the ending balance in the account.
Mm-hmm.
So in this case, it will be. I'm going to show you some key account. I'll just go right up. So the investment equity start out at 35,000. Okay, the dividends. Did they increase or decrease?
The dividends, they increased.
No, I'm sorry, the investment account.
Oh, sorry, the investment decreased.
Yeah. And again, it's just, you know, because we get the cash, but now our investments were $1,500 less. And then our share of the income was 6,000. Add that in. Now, do my spacing very well here. All right. Well, that is 35,000. $89,500. So that's what will be shown on the balance sheet.
Mm-hmm.
Do that. And now notice that the stock price has nothing to do with, whatever the stock price is, we don't care. Well, I don't care, but is not included in this number. We don't go look and say, okay, this went up by $10 or down, whatever. None of that. It's simply based on things you do for your normal company. How do you make money? You make income. If you're an owner, that is reduced by whatever you take out of the place. So, yeah, but the actual stock price doesn't have anything to do with. You see me struggling here. It's because I put another computer down here. I got another keyboard, and whatever it did, my desk doesn't. I don't know. I got to make some adjustments.
Yeah.
All right. I tell you what. You want to do page 6 on your own?
Okay. Let's see. Okay, so 40% of Rue Company was purchased for 80,000. So that would be so it'd be January 1st. 40% of 80,000 would be.
Okay, now I think the way this is written is that the 40% cost 80,000.
Oh, okay, I got you. Sorry. Yes. Okay, so 80,000 goes in the debit as the investment equity account.
Mm-hmm.
And then cash goes down, it gets credited 80,000 as well.
Yep.
Because you are losing that asset, gaining the asset of the investment equity account. And then May 23rd, you're paying the dividends. So it has paid dividends to their shareholder. So 40% of, let's see, hold on, got my calculator. Okay, so calculator would be would be 10,000. So 10,000 cash would be debited.
Yep.
Because you're getting that asset, but then your investment equity asset would be credited also 10,000.
Correct.
Okay. And then the 21st or 31st, net income of 12,000. So that would be 40% of 12,000 would be 4,800. Okay, so you would be debiting the investment equity. That 4,800, and then your equity income would go up 4,800. So it would be credited.
Yep.
And then, so your ending balance would be, let's see. So you would start with 80,000 for your investment equity. And then you would subtract the dividends of 10,000. And then your income would go up by 48,000.
I think 4,800.
4,800. That's what I wrote. And then, so that would be, let's see. So that would be 74,800 is your, would be your investment equity at the end of the year. Or
Yep.
the ending balance. Okay. All right.
Yeah, and that one, you notice, oh, I left a zero off here. It went down, and that's because they paid out more dividends than income.
Mhm.
You say it was 75 or 74, 800?
74, 800, yeah.
Ooh. Yeah.
That's, yeah, that's correct. Okay, yeah.
Yeah, and yeah, so the investment went down. Now, no, again, nothing to do with the stock price.
Mhm.
So when you do these problems, they might give you the stock price. And then we say, oh, the stock went from,
Like on the CPA exam, they try to mess with you
yeah,
that way.
yeah, they say, the value of the stock went from $8 to $13. Maybe the stock increased in price. For this method, it doesn't make any difference. It went down as an investment. Stupid dog. Okay. Oh, this is kind of a different topic. So it's good to be in the basement right now. Get the dog to be quiet. So here's the thing: when you're investing in another company, it matters on what you're really buying, and that is that if they have something on their books that say is undervalued, especially that when you buy it, notice that the company that you bought, they're depreciating it from a lower amount. They may have a building that's been on the books for 50 years, and maybe they're carrying on the books at $40,000. Maybe it's worth $4 million. Now they're not idiots. When you buy into the company, they're going to know that you're going to buy part of pay for part of that $4 million building. Well, they might be depreciating it based on 40,000. So their income, is really somewhat inflated in that the asset is, as far as you're concerned, anyways, when you're buying it, that asset is actually worth much more. And so one of the things that we have to do for this method, because you are actually buying so much of the company, that you're actually buying, sort of like buying the assets and liabilities and so on, that you have to make the adjustments to the income based on what you paid for it, not what they paid for it. They may have paid a lower amount, but what you paid for it, it's that building example. Well, you bought in based on a $4 million building, not a $40,000 building. So it changes the income. Change it. And this is kind of just an example that Tom owns a restaurant. Tom buys nothing from Sarah for $700 cash. So Sarah had on her books at $460, but Tom paid $700. So Tom is going to put on the books for what he paid for. It doesn't matter which Sarah paid for.
Right.
Okay, 1 second. Can't take care of that now. All right. Okay, Tom buys an oven for. Okay, I'm sorry. Okay, so this probably be equipment. You can also put down books.
Right.
cash. Oops, this is an asset going down. I'm teaching a 210 class. Next week we go into journal entries. Michelle's eyes just glaze over. What are those? Some weird thing we came up with 400 years ago. All right. All right. So prepare the journal entry for depreciation. Okay. So in the oven, that's being used to 10 years and residual. Okay. So. All right. So Tom is going to appreciate this. And remember that journal entry by dead.
Right.
Oops, 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 oops. Depreciation expense. Okay, so Tom's going to depreciate. So what is this? 10 years with no residual. Okay, so 700 divided by 70. So Tom's going to depreciate $70 every year.
Mm-hmm.
Okay, so this is just normal. This is normal business right now. So Tom bought the oven. Tom has to depreciate it. Now, if Sarah had kept the oven, with the depreciation of that?
So it would have been $46 a year.
Yep. Yep. So if she had kept it, it would be $460. Okay, what will be the incremental impact on Tom's depreciation expense versus Sarah? Oh, okay. How much more would it have been? Okay, well, if Tom's was 70.
So it's just $24, right? 70 minus 46.
Exactly. Did you say it was 24?
Yeah, 24.
Yeah, so the difference would be $24. So here's the thing. When you buy, if Tom were to buy Sarah's business, notice that Sarah wouldn't have actually sold Tom the oven, the whole business. So Tom would have to, now Tom would have paid the same, $700 as part of the purchase for that oven. So this difference here of 24 would be what Tom would have to include this additional amount on his financial statements. And that's what we're going to kind of is how much more depreciation would there be if when they were at the fair value, if whatever you're buying, the assets you're buying when you do make the investment, which is basically what you're doing, you're making the investment based on the assets and liabilities at that time. How much additional would it be? In this case, it would be $24.
Mm-hmm.
So that's kind of what we're going to do now, going into the future here. And this is where it gets a little bit tricky. Okay. So I'm going to okay, so here we have, what am I doing here? Here we have the carry value of the assets and liabilities. And so the net assets of this would be In other words, what is net of the liabilities? What's 370 minus 190?
70 minus 190, 120. Or 37. I'm sorry, that would be.
I just put the numbers in wrong. Oh, so it's 370 minus 190. 180? It's 180.
Yes.
Oops, that's 18. That's not the right number either. Okay, so this is basically, and this would be the book value here.
Mhm.
I'll get it closer. Oops, that's too close. Okay, now over here, we're going to do the fair value of it. So let's see here. If we add all these up, $30, 60,
410.
Yep. And these, I think, are the same.
Mhm.
$220. Okay, so that's the so the fair value of the assets is 220, and you'll notice that who did this? Signals Corporation. Back up here a little bit. So Signals Corporation bought 25% of it.
Mhm.
So that's how they came up with the price. You take 25, times 25%. Equals 55,000. Okay, I'm going to step away for just 1 second here.
Oh, sure.
Okay, sorry about that.
Oh, no problem.
Hopefully there'll be no more barking.
Mhm.
At least by me, there'll be no more barking. Okay, so this is how they came up with that 55,
this.
Right.
But they bought 25% of the, and again, this is the fair value. Now, over here a little bit. Let me zoom in a little bit. So there actually is some excess value here. Current assets, 0, there's no more, there's nothing there. Land, same. But the buildings, you'll notice, are worth $40,000 more.
Mm-hmm.
Equipment, same. Okay, so this excess value. Now, notice that this is a depreciable asset. If this was land, it wouldn't matter.
Mm-hmm.
But this does matter because it's a building and that's going to depreciate. So when we calculate our income, we're also going to have to look at this excess value. Now, this excess value is for the entire business.
Mm-hmm.
So this excess value signals portion will be times 25%.
Maybe 10,000.
Yep. And so this is what they're going to have to depreciate, basically. But we'll see how we get it. When we get down here, we'll do this. Okay. So let's take a look. So this was bought on January 1st.
Mm-hmm.
55,000. So that'll be the same. Mostly they're going to be the same as before. Okay, so at this point, we're no better or worse off.
Right.
Okay. Let's see. So they have significant influence. Okay, it's not controlling, but they have influence. So net income of and pays dividends of 30,000. Okay, so usually dividends are paid through. It doesn't matter which one we go first. We'll do dividends first, just because it'll be the same as the previous ones, I guess. All right, so dividends, 12. Actually, this would be exactly the same as this one, right? 12,000.
Oh gosh.
Who made this stupid?
Oh.
Okay, well, all right. So we'll do the dividends first. So this will be the dividends. Yeah, I'm not going to put it there. I'll put it over here. So it's not a part of the entry. Okay, so dividends, this is 1231, I guess. Okay, so they received cash. And again, that is for 12,000. I got to change that. 12,000. Times 25%. Oh no, it will be different because it's a different percentage.
Yes, 3,000. So 3,000. Yeah.
Okay, so our cash went up by 3,000. Oops, we need zeros. And our investment went down. So when we get that cash, we are not saying will be because it's basically our
bring
cash.
down our equity.
It's our cash already, so. Okay, the income, 3,000. All right, and this is the kind of weird one in that it's going to increase our investment and increase our income.
Mhm. For the net income of 30,000,
Yeah, whatever, 25% of it is.
well, 25%, right?
It was like, no, the 7,500. I don't know, I'll do it. Time for Mr. Calculator. Okay, so yeah, I gotta make additional spaces. I didn't plan this one very well. You may want to insert some spaces here. Insert some. Well, actually, if I didn't put this stuff, I probably would have made it. But okay, so this would be investment. This would be. Okay, so 30,000. Oops. Okay, now, here's the thing though. And there's a couple ways that we could tackle this, but basically, this 30,000 of income
Mhm.
is really based on the buildings being valued at 200,000. When we bought in, the fair value of those buildings is 240,000, so $40,000 more. So we have to depreciate our portion of that
Okay.
by, to make up for it. Okay, so they tell us that the excess building will have a useful life of 5 years. Okay, so this is the calculation first. So this would be the excess is 10,000. Oops, divided by 5 years. $2,000.
Okay.
Now, journal entry for that. They call it the amortization. Notice that this up here, this journal entry, this is when we pick up the income. Right, the income goes up. Now, this is one of those unusual things that I told you didn't happen, but in this case it will. We have to decrease this income by 2,000. And we also have to decrease our investment by 2,000 because our $40,000 excess here that we have 10,000 of it is actually going to go down over the next 5 years. Okay, so what would the journal entry be?
So it's wait, let me think about this. Amortization. So it's just the depreciation, expense, and asset depreciation at 2,000 per year, right?
Yeah, but you remember, well, we don't have their this stuff is actually not on our financial statements. We don't actually have buildings on our books.
Oh, okay. So yeah, then I don't know.
It's actually gonna be the same entry except reversed.
Oh, okay.
So, you know, we again, we can't go into a specific account here, but we do know that that investment account is now gonna be worth $2,000 less at fair value than what we paid for it. So it's actually just gonna reverse that out. So our equity and income is really not 7,500. It is 700 minus our investment. Somewhere in that investment where there's an additional depreciation.
Mhm.
Of, $2,000. Now you're absolutely right. It is depreciation. It's just that we don't have it on our
Because
books.
it's not on the books because it was,
We do
because
consolidation.
we don't have the, right.
But actually, you're what you said though is actually true. When we do consolidations, it will be on our books, and we will have to take it right out of the account.
But that's when the companies are merged together. It's not,
Exactly.
right. It's not a percentage owned through stock.
Right.
Okay.
Okay. Let's see. Okay. Man, I put a lot of them on here. I'm sure there's a reason for them. I think I know. Yeah, I think it's. Yeah. Okay. All right. So let's go to. Reading that around the space. A quick look through this one to make sure there's nothing exciting. Okay, yeah, see if you can figure this one out.
Okay. All right, so the fair value is, this time it goes up by 50,000 because of the difference in equipment, so it'd be 37,000 is the fair value. And, but the liabilities would remain the same at 180,000. Because so there'd be the excess value of 50K. Only on the equipment, not on anything else, and that would be times 30 or 30% would be, let's see, would be 15,000. So that would be the excess value. Okay, so in that case, let's see, the net assets would be 320 minus 180, right? For the book value. 180 equals 140. So that would be the book value, and then let's see, so net assets would be 370 minus 180. So that would be 190, the fair value. So if they're doing 30% of 190, that would be would be 57,000. Okay, which is what we know, that's what they paid for.
Yep, so they paid exactly what the
Right. So then in the journal we do on January 1st, they did the investment equity would be the 57. So we debit investment equity and credit the cash in 57,000 for both. Okay, so that's easy. And then dividends are 30,000. So when we do the dividends on 12/31, that would be, let's see, so cash would be debited and investment equity would be credited. And that would be, let's see, 30,000 times 30 would be 9,000. So we are going to debit cash 9,000 and credit the investment equity 9,000. Okay. So then income would be income 12/31. Okay, so income would be the so it would be 30% of 100,000 would be 30,000. So we're going to is that right? That's, yeah. Right. So okay, so 30,000. So we're going to debit investment equity by 30,000. And we're going to credit equity income. Okay, and then so then we're getting to the amortization of the equipment. Which would be, let's see. The last time we had, oh yeah, 3 years there. Sorry, I didn't see that. 12/31. So amortization 12/31. So okay, so for the amortization, we would debit equity income and credit investment income, and that would be 15,000 times 3, which would be 5,000. So we would be debiting equity income and crediting investment income 5,000.
Yep. Okay. So oops. Okay. Yeah, so and again, this is just reversing that out because now after 3 years, we don't do this anymore. After 3 years, that'll be gone. Oop, we're going to do that. So yeah, so if you have this thing for investment for 10 years, after 3 years, you stop making this.
Right.
At that point, gone. Okay. Okay, now this one is a little bit tricky. And then they tell you the book value of the stock purchase was 260,000.
Mhm.
So that's kind of like this. They're telling you that this was 260,000.
Right.
You know, their portion of it. Right. So I mean, if this was, you know,
They paid.
what's 342? Yeah. So it's sort of like this. You know, they're telling you that this is the value of the stock of the purchase. They paid 300. So this is 260 would be the, you know, this would be 400. So this 15,000, for example, is the difference between those two. You know, 15,000. You know, the book value of what you bought was 42,000. The fair value was 57,000. The difference was that.
Mhm.
So they're telling you that that difference is due to, I don't know, is it a patent or something? Should probably get back to the problem we're working on. Okay, yeah, so the difference was for the patent. So they paid 300,000. So I mean, that's just the entry right there. That's, you know, whatever they paid for it is the journal. I don't know why I cannot spell equity. There can be a strange situation where it doesn't work out. You remember put that in the last one or not? Okay, so the rest of this is kind of straightforward. So it's a 25%.
Right.
But again, these are already at the 25%. Right. So, you know, this is what they paid for the 25%, 300,000.
Mhm.
And the book value of the 25% is that. So these both are already, so you don't have to multiply those by 25%. Just a different way of doing it. This is one of those things that you know, when a book tries to, whatever, they try to make it easier. And it makes it harder. So these two are already, you know, the 25%. So this book value is 25%. So the difference between these, two is what you're going to amortize the additional amount of the patent. So when you take the difference between these two, you don't have to multiply by 25,000 or 25%. So you don't have to do 25% because they're already both at 25%.
Oh, okay, so the difference is the 40,000 total.
Exactly. All right, I will be quiet and see if you can figure it out.
Okay. Okay, so investment equity, so dividends would be, net income would be 25% of 60, so 15,000. So we would, dividends at the end of the year, debit cash, and then credit investment equity, 15,000. Okay, so that's okay. So then when it comes to income, so then the income would be, let's see, net income of 10,000, so that would be 25,000. So we're going to debit investment equity and credit equity income, 25,000.
Yep.
And then the amortization is, would be, okay, so let's see, amortization. I guess the patent is the 10 years. Excess was due to the patent, so the patent is 40,000 over 10 years, so that'd be 4,000. So we'd be debiting equity income 4,000 and crediting investment equity 4,000.
Right.
Okay. And the 40,000 is because the 300,000 minus the 200,000, that is already after the 20, after timesing by the 25% interest.
Exactly. Yeah.
That's right. Okay.
I'm gonna show you something else that's kind of strange about this method.
Mhm.
It is, there's a little something about the journal entries that kind of make this one stand out a little bit. Every single journal entry has the investment account.
Mhm.
So, you know, every single one of these entries is it has that investment account. So really what you're looking for is just the other. How are you doing that? How are you walking around with the
Oh, I just had to pick up, I just needed some water.
no,
Sorry.
but no, but how's the camera following you?
Oh, I just carried my laptop over. I
Ah,
just didn't want to miss anything.
okay, okay, that's fine. Well, you know, if you need to take a break, well,
Oh, no, that's okay. I just wanted to get more water.
okay. It looks like she's moving around. What's happening? All right. Yeah. So the investment accounts in all of the journal entries, basically, which is kind of a strange thing, but that's just the way it works out.
Mhm.
So, you know, if the question were how much income did they make on their investment, what would the answer be?
So then it would be 30,000 minus 15,000. I'm sorry, 300,000 minus 15,000 plus 25,000 minus 4,000. So that would be, let's see,
Okay. Yeah. No. Be careful. What you said is
Nope.
actually the balance in the account.
the balance. Okay, I'm sorry. Oh, what I was thinking, I thought you meant if we were just looking at the investment equity. No, I'm sorry. What?
No. What you said is absolutely fine. You're right. So let's do the balance in the account. That'd be so. Dividends.
Yeah, it would be minus 15. Plus 25.
How strange. It changed the size of it. Wait, what's going on here? Okay, and then we have the amortization. Oh, well, we have it's a big and huge. Okay, so amortization.
So it would just be 306,000.
Yep. Ooh. Okay, now, the question is, how much income did they actually make on the investment?
How much income did they actually make? Let's see. So is it just that they made, I'm sorry, is it just that we're just looking at equity income, right? Which is just that they lost 4,000?
Well, they made 25,000, but then subtracted out 4,000. So yeah, so
An equity. Yes, you're right. Sorry. I see that now.
so equity.
Okay.
Yeah, so they made 25,000, but then we also do the amortization. So the actual income for this would be
21,000.
I'll see net income. That's gonna sound funny, but anyway, the real income that they made is 21,000. Yeah. So that's it.
Right.
And then for the next 10 years, you can pay out that $4,000.
Because of the patents.
Yep. What's the last one?
It looks like the main difference is the goodwill.
Yeah. So there's a difference here of what is it, 50,000 total?
Mhm.
And we haven't talked about what goodwill is.
Yes.
Goodwill is just changing the sign. Okay, so so this is the purchase price. This is the book value. So the total excess is not spelled like that. Total excess is 50,000. Okay, now they said that a copyright, oh, that 50,000, that a copyright is for 30.
Mhm.
Now they have a way of describing these as they don't have the book. I'm not positive how they do it, but generally they'll talk about identified assets. they look at them and they say, okay, this was worth more money. They know exactly what asset it is, it's worth more money. Okay, so they have a copyright. There's 30,000 of it.
Right.
Now, they also have what they call unidentified assets. And this is what we're generally talking about is goodwill, and I'll talk about that in a second. Okay, so of that 50,000, so that 50,000, the identified assets, 30,000. And the unidentified assets are going to be called goodwill, and that is for the other, what, 20,000? So that 50,000. I know I'm gonna make a mess out of this, but
Right.
of that 50,000, 30,000 of it was identified assets, and the unidentified assets were another 20,000, and that's going to be generally goodwill. Now, here's what goodwill is. Goodwill is when a company makes, generally they make excess profits. So, for instance, if you, as an example, if you were buying a McDonald's business,
Mhm.
McDonald's makes, whatever, 3 times as much as the normal hamburger place, whatever it is. You're going to have to pay a little extra because it's not just the value of the assets. They have a tremendous marketing. People see the sign and they come in from wherever. And so they make more than, so they, even though they may have the same assets as any other fast food place, their profits may very well be far above what the normal place would be, or somewhat above it. So when you buy into it, the people who are selling it aren't going to be stupid. They're going to say, okay, wait a minute, we're making more money than the average place, so you have to pay a little bit more because of the way it's run. So that's what goodwill is. So when they say unidentified, they say, okay, there has to be some reason why. So you go through all the identified assets, and once you get done with those, and these are things that you may or may not appreciate, then it goes into goodwill. So anything that's unidentified would be goodwill. Now, the nice thing about goodwill is it is not amortized. So we don't have to do anything for it. It just sits there like a lump.
Okay.
So now we are going to do something with the copyright.
Mhm.
This for 5 years or whatever. And again, this is based on 35%. So this is for 35%. And this book value is also based on 35%. It's already taken out. So you don't have to do anything else to the 30,000. It's already been adjusted to be the 35%.
Right.
So, these are all 35% figures. Oh, it's the same 40, no, it's 30,000. 30,000.
Okay, so this, wait. Okay, so the 6,000 is because we are doing the copyright 30,000 divided by 5 over the 5 years, and we don't do anything with the goodwill. That just sort of sits, right?
Right.
Okay.
Yeah, so it's the goodwill just will just sit there.
Okay, so the investment equity would be, let's see. Would be 449,000.
35.
420 minus 35 plus 70 minus 6,000.
You're right.
Okay. Yeah. Okay, perfect. And
Yeah.
then And then the income would be the equity and income of 70,000 minus the amortization of 6,000 would be 64,000.
Yep.
Okay, perfect.
So that'd be 64,000. Well, that's the handout. Yay.
That's the whole thing.
We
Wow.
made it through. It's I usually it takes a long. Well, I think we can probably get by with one meeting a week. If that's all right with you. I mean,
Yeah, that's fine with me.
yeah, because this one much faster than usual. So yeah. So I think for next week, I think I'll send you the practice exam and I'll have you work out.
Perfect. For chapter 1 or not for chapter 2?
No, just for chapter 1. And then
Chapter 1.
yeah, so then we'll go over the practice exam, then I'll send you out the exam next week. And come back now, next week we'll go over the practice exam, and then I'll send you out the regular exam. Just it'll be very similar. It's just one problem, I think. And then
Okay. Perfect.
yeah, we'll start on chapter 2. So
Okay. Sounds good. So next Friday at 4:30?
yeah, if that works for you.
Yeah. I mean, I can meet earlier, although, I don't know exactly when I'm going back to the office. So 4:30, that may be a nebulous time once I'm back in the office. I don't know.
Okay,
Just 'cause
well,
I haven't
here's the
yet.
thing. We can always change it too. I mean,
Sure.
The only times I can't do right now, I'm scheduled for Tuesday, Wednesday, Thursday at 6 p.m. But every other time is open.
Okay. All right. Well, we'll figure it out then. But next Friday should work just fine.
Yeah, and again, if your schedule changes, we can change this too. It's not okay.
Okay.
So okay, well, I'll be sending you that out until the next I don't know, 10, 15 minutes. And,
Perfect.
And you don't, there's no rush on it. Next week we come back, we'll go over it. All right.
Sounds good. All
Okay.
right. I'll see you next week.
Bye.
Bye-bye.